Welcome to the HC Commodities podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we return to the subject of investing in the commodities markets. What are the key narratives out there? How are they shaping opportunities or not? How does policy volatility and geopolitical volatility impact investments? And in a potential return to 1970s-style stagflation, what does that mean for commodities and portfolio theory? Our guest is Shaia Hosseinzadeh, founder and chief investment officer of OnyxPoint Global Management. They are SEC regulated, so I need to say the views expressed in this podcast are Shaia's own and do not constitute investment, legal or tax advice. Please note, investing in securities involves risks, including the loss of capital. You should consult your financial, legal and tax advisors before making any investment decisions based on the information discussed in this episode. Also, on the evening of September 30th, we have an HC Commodities podcast live event as part of the Argus Global Markets Conference in London, which is held on September 30th to October 1st. Our panel is Beyond Fundamentals, Adapting Trading Strategies to a Shifting Geopolitical Landscape. And our panelists are Saad Rahim, Chief Economist at Trafigura, Kurt Chapman, Director at LevMet, David Fife, Chief Economist of Argus, and Nick Kumleben of Greenmantle. The Argus Global Markets Conference is an excellent event. You have to be part of that conference to attend the live podcast panel, but I encourage people to sign up, and I'll put links to the event in the show notes. And many thanks to Argus for the invitation. As always, you can really support the show by leaving a positive review on the platform you're listening on. And as always, I hope you enjoy the episode. Shaia, welcome to the show.
Thank you, Paul. It's great to be with you.
Well, Shaia, I'm looking forward to this conversation. It's taken a while to put it together. We're talking about the global commodity space and investing it from essentially, a Wall Street lens. Before we go into your views and theses on the sector in the short term and the long term, can you just, I guess it's going to be important for the conversation, can you just orientate us as to OnyxPoint Global Management and your role and what you guys do? Because I think that'll be instructive.
Paul, it's great to be with you, and thanks for having me on the pod. So I'm the Chief Investment Officer of OnyxPoint. We are, for those of you who don't know us, an event-driven investor, and we're focused on the real asset space, and we have an emphasis on businesses and companies that operate in the commodity sector. We invest up and down the capital structure, which is another way of saying we buy equity and debt and everything in between. We manage a flagship public market focused hedge fund that we launched in about 6 years ago. We also combine that with tactical private market investments through our private equity funds. When liquidity is priced at a premium, we will also do investments in private companies, or when we feel like there is a real convexity or asymmetry to the risk and reward. I've been in the commodity sector as an investor in companies rather than the commodities themselves for the better part of 2 decades. And at the end of the day, for us, it's all about finding the highest return per unit of risk.
Great. Okay. Well, let's dig in. So let's start on the state of the market. And one clear element that has been playing out over the last couple of years, there might be some green shoots today, is what's been going on in let's call them new energies.
Yeah, and just to level set, when we say new energy, I think what we're talking about here is the promise of zero carbon or near zero carbon energy. And look, that's been a segment of the market that has had a lot of ups and downs, and quite frankly, a lot of false bargains. We can talk about that. Our firm, the way we've approached it is for the better part of the last 5 years to be largely to avoid it on the long side and to be episodically short. And there's structural reasons why that's been a very challenged segment to invest in. I think just to sort of level set, this is a market where before the passage of the Inflation Reduction Act, the total market cap of all the players in the US was somewhere the ballpark of, call it, 0.3 to 0.6 trillion dollars. The IRA really turbocharged the whole sector, pumping something like $0.3 trillion a year into a rather small and sort of technology driven and volatile segment of the market. So the result was valuations mushroomed from 7 times cash flow to something like 33 times cash flow at its peak. And there was a lot of zero cost debt that was issued. But it was a false dawn. I mean, I think the promise of quick, cheap, and zero carbon energy really has failed to deliver. And really, there's three reasons for that. Number one is we wrote about this 3 years ago, one of our essays. There's a accountability deficit. If you think about the average CEO of an S&P 500 company, the average age is 58 years old. And if you're making promises to get to net zero by 2050, it's pretty clear that those CEOs will not be around. So in effect, they're issuing an IOU that's an intergenerational transfer to the next CEO who will have to default on that commitment. Number two, there's an ideological divide. We see this all the time where I think a lot of people want to invest to save the planet. They want to do what's right. And there's been a large number of companies where the narrative overwhelms the fact, and there is no accountability for what will be delivered. And finally, number three, there's information asymmetry. It's very hard to verify some of the claims these companies have made. The timelines are quite long, and so it's not something that can be verified in a quarter, a year or two. It has to be measured over 5 to 10 years. And then lastly, there's a very large incentive structure for lying, for being dishonest. And as Charlie Munger famously said, show me the incentive, I show you the outcome. You put all this together, it's a very powerful and flammable combination that has essentially now come back in with valuations going back to half of what they were before. There's a building pile of distressed debt. We started with 2 billion a few years ago. Now it's 12 billion and it's growing. And quite frankly, a lot of these companies are teetering on the edge. If you think about some of the typical issuers in the clean tech space, these are companies today that are sitting on a large amount of low cost debt. This is debt that was issued when interest rates were zero. These bonds are going to mature in 26, 27, 28. Because the coupons are low, they're trading at 60, 70, 80 cents on the dollar. Doesn't mean they're going to default tomorrow. But what that means is you're going to see a slow transfer of value from the equity holders to the creditors as this capital structure matures.
Yeah. There's a lot there that's sort of temporal, right? There was a hype bubble. There was a lot of lack of understanding, frankly, from investors on, I include myself in this, right? Hydrogen sounded great, right, until you dug into the thermodynamics. And obviously there was a lot of cheap money at that time. I guess my question is, we're post that, and there's a question of time frames here, which is there was the bubble burst in terms of the short term frame, right? The 2020 to 2025 time frame. But is there an investment thesis when you look out over the long horizon, i.e., the sense that ultimately we are going toward the electrification of everything? Power is cheaper from renewables if you can get the intermittency right and combine it with nukes and so forth. But ultimately, all of our technologies in the future are going to be battery based, etc. And that this is something over the very long term, if you can get it right, it remains an opportunity to invest in. Or I guess the counter to that is these are, in some ways, Wall Street has been spoilt by technology investment that is infinitely scalable, right? You invent the piece of software and it can be in every single computer around the world and you win that market. With renewables technologies, they are hardware. They are technologies, they're not fuels. They are hardware, and each one has to be built and installed. We're not, it's not software. A lot there, but can you give us some sense of where you see renewables over the next 10, 15 years?
Well, there's a lot to unpack in there, so I'm going to
Yeah,
try
sorry, compound question.
So I'm going to try to hit a handful of those, and we can come back and talk about the rest if I miss them. I take a little bit of a different lens on, I think the term you used was the electrification of everything.
Yeah.
There are a lot of structural reasons probably beyond the scope of this conversation, that impede the ability, the physics of electricity and electricity storage is such that you're going to have a structural limit to what can be electrified. So if you look at the share of fossil fuels in the total energy pie, it's 80% today, 80, and it's been stubbornly at that level for a very long period of time. And there are certain segments of the global economy that just simply today and quite likely for the near future will be incapable of transitioning to electricity. That's the first piece of this. So I think there will be a role for fossil fuels for the foreseeable future. That's kind of point number one. Point number two, if you think from first principles and you look at past precedents where we've had transitions from one fuel to another, there's an enormous amount of time, money, and infrastructure that needs to go in. And if you think about, for example, moving off of kerosene as one bookmark, it took 50 years to do that because you have to essentially rewire, no pun intended, the entire demand infrastructure to go from fossil fuels to electricity or from fossil fuel A to fossil fuel B. And so that in of itself is not a quick, easy fix. And that's kind of point number two. And point number three, as it relates to renewables, I do think there are some technologies within renewables that are more viable than others as measured by levelized cost of energy, intermittency, the total carbon footprint, as well as the economics of constructing and operating them. But I think the problem that we have is ostensibly the reason to go to renewables, we're told, is because of its low carbon footprint. There is no global standard for measuring the life cycle carbon footprint of these assets. And I suspect over time, as that develops, people might be somewhat negatively surprised that a lot of these renewables do not deliver on the promise of reducing the carbon footprint. And a large reason for that is that the energy input to the energy output ratio, in other words, the amount of energy you have to expend.
We're in Iroi territory.
Right. So when you have something where, for example, fossil fuels provide 30 times the output of what's gone into them, it's really difficult to trump that from a carbon footprint standpoint as well as from efficiency economics. So long way of saying that I think it will be, fossil fuels will have a role to play both structurally and also from a carbon and cost basis. And you also asked about opportunities. That's not to say that there are no opportunities. I think the bubble is slowly deflating. I think you characterize it as bursting. I'm not sure that we've seen it burst the way that, for example, the tech bust happened in the early 2000s when I was starting my career. I think this will be a slow transition as these companies are weaned off of zero cost of capital debt. One of my favorite stats, I did a presentation in, I think it was 21 or 22 to the CFA Society, where we talked about why we were shorting some of these companies. And at the time, you could issue long-term debt as a renewable, as a green compliant company at a cheaper price than the United States government, the federal government, which obviously sounds bonkers. And so as these companies are weaned off of this, cheap debt, and they come out the other side of COVID, these companies are going to slowly start transitioning value to the creditors. So I think today, as we said, there are some opportunities to dance between the raindrops in the clean tech space for those of us that can invest across the capital structure. And I think we're going to see that pile of debt and that pile of opportunity steadily grow, particularly as we start to see capital increasingly going to things like clean coal and certain fossil fuel sectors that maybe 3 years ago would have been a non sequitur.
Iroi, this whole thing has had a long-standing debate on this podcast with different experts coming on to talk about it. So I would invite listeners to go back and check those out. But yeah, it's definitely a challenging space. And as you say, a lot of this is a function of, we're going to look back at the incredible cheap money that we've had over the last 15 years. And we had Edward Chancellor on the show talking about just that and the bubbles that it's created across different sectors. And to the point where today you hear, people bemoaning 5% interest rates on 30-year, bonds, when that's been the historical average, right? And you've had, there's got to be a generational reset as to kind of the expectations around what money costs and what time costs. That aside, that segues quite nicely into copper. Copper is wound up with this, an electrification of everything story, narrative, as well as a great need to replace aging infrastructure across the West in grids, upgrading grids, and then, of course, the AI story. Before we move on to AI, let's just talk copper for a minute. Where do you see that market?
It's interesting that you bring up Edward Chancellor. I think he has been a seminal author on, or he's been an author on several seminal pieces that affect the commodity cycle. And I think his work does have direct application to copper. Look, I think at the heart of, maybe just to step back for a second to frame this, I think at the heart of commodity cycles lies this concept that interest rates are somehow compensatory for time. And I think Chancellor had a pretty interesting book on this where he talks about, I think it's entitled The Price of Time.
Yeah.
Look, I think ultimately interest rates are a very imperfect reward for human time preference. People and markets are impatient. They prefer to invest in companies that deliver profit and growth today rather than at some future point in time. And while corporate finance will teach us that you can discount everything back using a discount rate in theory, in practice, the discount rate whipsaws because people's preferences and willingness to endure long periods of time is not really sufficient to maintain a smooth sort of cost of capital across time horizons. So if you come to copper now, look, I think when we invest in companies, I should have probably make it clear here that we don't invest as much in the commodities themselves. We're an investor in the businesses. We always look at, our team hears me talk about this all the time. We always look at what we call the four narratives. And the four narratives are the buy side, the sell side. What is the buy side thing? What is the sell side thing? What is management telling you? And then there's the truth. And quite frequently, those four narratives never really, very rarely ever align. And so the issue with copper is it's caught in a classic tug of war between powerful long-term structural tailwinds, which you touched on, but offsetting that is you've got these persistent near-term headwinds, that uncertainty around the global macro picture, trade policy frictions. We saw the impact of the copper tariffs whipsaw prices just last month. You've got anemic demand in China. The building cycle there on the residential side's down sharply. You've got slowing EV sales, the restart of the Panama mine, et cetera, et cetera. And then to add to that, you've got the financialization of copper. So if you think about ETFs, they represented something like 5% of total copper volumes just 5 years ago. That's swollen to almost 15% today. So copper prices are more a function over the short term of financial flows. In fact, you'll see a greater correlation to things like NVIDIA or the ARC ETF or things that you would not normally expect to drive copper prices. And so you have this slight disconnect, or maybe more than a slight disconnect, that's happened between the prices in the financial market and the fundamentals. And so copper has been a pretty unpleasant experience for many in the last 2 years who've been chasing that long-term story, forgetting that, so the narrative, obviously, it, and I think a lot of your listeners are probably familiar with it. We're electrifying everything, and copper is a key ingredient. And so that's been a strong part of the sell side narrative. And in fact, it's been the buy side narrative. But the truth is that the reward at the end of that rainbow is not for 3 or 4 years, maybe longer out. And in the meantime, you're being whipsawed by all these headwinds and all these financial flows, which has made it quite difficult as an asset class. And then for those of us who invest in the companies themselves, there's not a lot of high quality businesses that you can invest in today that can
Yeah.
give you returns independently of the commodity. So it's been a tough place to be, and we've largely avoided it for the moment for those reasons.
The energy and resources sector is experiencing unprecedented change. To help navigate this change and capture its opportunities, HC Group launched Enco Insights, a global advisory network dedicated to the sector, providing senior advisors and subject matter experts to investment and infrastructure funds, law firms, and corporates. Enco Insights leverages HC Group's 20 years of connections in energy and commodities to give clients the expertise they need when the stakes are high and insight matters. Learn more at encoinsights.com.
Isn't that a narrative that you could cascade across, many, let's call it, the critical mineral space in general? That ultimately you're sort of playing financial sentiment, they're highly financialized, you're playing political sentiment, and you are really the underlying asset. It's hard to also invest in a critical minerals miner or processor. There are very few, they're highly concentrated. Again, you kind of come back to the situation with renewables 5 years ago. But ultimately, a lot of it is, it's hard to see in the long term how these are going to be returning significant free cash flow to shareholders.
Listen, I think you're right. At the heart of a lot of these esoteric metals and mining greenfield project, and I think what we're referring to here are more projects that are the good stuff is on the come. The reward will come for those of us who can wait 5, 6, 7 years for some event to catalyze production to happen and cash flow to flow. The problem is between now and then, these are all very narrative driven. You talked about the rare earth metals. Clearly there's a almost a meme stock component to some of the few of those names out there because of what's been happening with announcements by Apple and the Department of Defense. And so really the market struggles to put a price tag on these companies because nobody really knows how much they're going to produce, when they're going to produce exactly, what it will cost. And so ultimately, the market ends up trading these companies more on the flow of the news and the narrative, which can have some really sharp movements in both directions. And obviously, for the moment, that direction seems to be only in the direction upwards. But trees don't go to the sky, and when the support dissipates, a lot of that is at risk of reversing.
Yeah, and we'll come on to some of that aspects in the Trump presidency as well, because there's also a bit of an increasingly government interventionist process going on here. And you can just look at those stocks and you can essentially see them as bellwethers for the relationship with China. And one does, it's not necessarily good to have feedback loops, that are financially incentivized there, but probably another matter. So the other big narrative that's out there before we move on to good old hydrocarbons and the midstream and upstream space is AI. We've done some real deep dives into how I guess from our world, this is a data center story and a power story again. But can you give us some sense of kind of what innings we're in, using your phraseology, with AI?
So there's an interview question I normally like to ask people who I'm interviewing, and I suspect by telling you the question, I probably won't be asking it very much, but I think this will help tee it up in terms of exponential growth and the challenges of understanding that for most of us. So I'll pose the question to you, Paul.
Oh, God.
Would you prefer $1 million today or a penny stock that doubles every day for 30 days?
I think the latter is the right answer. Don't I get like 10 million or something?
You get quite close. Your answer is correct. So and this sort of the spicy part of this question, if you want to go a step further, is that you actually get to your break even on day 28. And so there's kind of two.
But after that, you're absolutely crushing it.
You're just because you're doubling, right? So you get
Yeah,
to
yeah.
1,000,003 on day 28, and then it's double that. And every time you double, the growth, the dollar growth just becomes gigantic. We, when the pandemic happened, did a similar exercise that proved to be quite helpful in terms of loss avoidance and being able to have dry powder to go in and take advantage of the market dislocation. Well, why am I telling you about this? Let's just table that for a second, and I'll come back and talk about it in a minute.
But I have passed the interview.
You have
Give
you've
me
absolutely
that.
you've aced it. So if you think about the adoption curve, people talk about S curves. S curves basically refer to something that starts with a high rate of growth on a small base, and then the slope kind of steepens and then flattens. It can be applied to a lot of things from innovation to adoption, et cetera. So if to just put it in concrete terms, it took 100 years for the telephone to penetrate US households from the late 1800s to the 1900s. And so that 100 years for the telephone compressed to 10 years for the smartphone. If you think about AI, it's even faster than that. So, for example, Instagram and Facebook took something like 6 years to get to 800 million subscribers. GPT did that in under 24 months. So, in terms of the innings, where are we? Look, nobody really knows, but I think what we can do is develop a mental model to try to begin to understand where we are and the exponential quality to what AI offers. So I'll throw out some numbers just to sort of level set here. I think it was McKinsey or somebody who estimated that if AI has one use case, for example, all you ever do is you go on ChatGPT to find, a review for a restaurant you're going to go to for dinner tonight. Then if that's all that AI is good for, then we're at a 78% adoption. But if you assume the use cases increases to 3, which is, I think, still unreasonably low, you're at 45%. If you assume 5 use cases, 16%, so on and so forth. So the question becomes this: what are the use cases for AI? Is it just a GPT search? Is it Copilot that then sits on top of your Microsoft Office? Is it Copilot agentic AI that you can basically have as a substitute for a knowledge worker that uses a large language model? Microsoft just released a GPT-5 in Copilot, which can do a lot that you normally would want an assistant to help you with. Is it autonomous driving? Is it healthcare diagnostics? Are there consumer devices like Siri, wearables, so on and so forth? Every time you add a use case, your penetration figure goes down the curve. So for that reason, we think we're in the takeoff phase. We haven't even begun to scratch the surface. Now, in terms of maybe just dimensioning it back to this conversation, which obviously is more about commodities, first generation Google search will use about 0.3 watt hours of energy. The early generations of GPT use 10 times that much, which is 3 watt hours. You're using some of the more complex deep research algos, you're looking at 25 times the energy usage. So to sort of bring it back to exponential growth, when you layer on top, one of the things that causes exponential growth is when you have compounding forces that add to the momentum of each other. So you've got low penetration, increasing use case, and then on top of it, orders of magnitude greater energy use. And so in 2025, we had something like 1,000 data centers that were AI ready data centers. These are different than your kind of run off the mill data centers. By 2030, that number is projected to be 3,000. I think NVIDIA reported last night they might have actually raised the specter for what might be on the table in 2030, but let's just assume it's 3,000. Each of these data centers consumes as much energy as an aluminum smelter.
Yeah.
And so that right there for you is the compounding that's happening in our markets on the energy side as a result of AI.
And we can see that in like power services companies and their stocks and stuff. And I there's a friend of mine, Eugene McGran, who we've had on, who works for Cushman Wakefield, is at the ground center of trying to hook up, finding facilities, space, and obviously connecting them with the power sources from a real estate standpoint. I completely agree. There's exponential demand at the moment. I think the penetration is incredibly low. Just in my own life, I spent the last few Saturdays sort of being dragged around tile shops looking at tiles. And it's kind of amazing that I've been using ChatGPT, taking a picture of the tile, loading it up against the kitchen backdrop where it's going to go, and immediately getting a view of what it would look like. And I've had tile salespeople crowd around me, looking at me doing that, looking like I've got some kind of secret wizardry tool. It's amazing that they're not using it yet, right? I mean, I think the use cases are, as you say, I think there's an exponential growth there. The one thing that does give me pause, and I don't think it's about today, I think it's about some period in the future, is obviously power is going to be the cost in these data centers, or let's say energy. Usually when that happens, you start solving for that pretty quickly. And so, I don't think we can assume ever-growing consumption of wattage for searches, and I think there are going to be solutions to increasing the efficiency of these centers as well, right? Otherwise, you're going to get in a world where actually you're going to see significant power prices go up, just for residential, because you're competing with these businesses. So I think that's all in our future. But yeah, I think that it is a pretty compelling story that weaves into utilities, that weaves into anyone who's in and around providing these data center services.
And what you're touching on here is the OpEx related theme from which we can invest, which is the power side and those picks and shovels, rather than the CapEx related theme, which tends to be more upstream in semiconductors, GPUs, et cetera. And I think there's a lot of merits to that approach from a risk and reward standpoint, given some of the uncertainties that I think you've highlighted.
I'm looking at the oil sector, the hydrocarbon sector. It's kind of the reverse, right? Unloved by investors over the last 5 years. There's been some very savvy companies out there taking advantage of very cheap asset prices, hoovering up hydrocarbons, so to speak, and others, whom have been very sort of disciplined and rigorous around cash flow and capex and all these pieces. And today, there's quite a bit of concern growing about they haven't invested in recoverable reserves. Anyway, I'm prefacing too much. What's the view? Have the great opportunities gone in the midstream and upstream, or are there still opportunities out there? What's the thesis?
It's a little bit more, I think, nuanced than to just take a broad swath at the sector. So if you look at the 2010s and the shale revolution, it was all about grow, 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 and the next benches to be commercialized, and started in the Midland Basin, moved to the Delaware, and then you start to have the core differentiated from tier one, tier two. I think that the industry today is transitioned past tense from growth to maturation. And if you look at empirical precedents, the way to make money in industries that are not growing as a whole is to really identify what, in hedge fund jargon is idiosyncratic, things that are very specific to a particular company or to a particular segmented product within, let's call it oilfield services, or it's something that's very credit driven. So, where we sit here, the sector, I think you can argue by a lot of conventional metrics, is cheap, whether you look at free cash flow yield or whether you look at, net asset value or what have you. But then I go back to the same thing we talked about earlier, the price of time. People are impatient. The market prefers money, profits, share price appreciation today over some promise of, the net asset value of 30, 40 years of reserve sometime in the future. And so for that reason, I think it can stay cheap for a long period of time. So what is idiosyncratic in this sector today? Clearly there are little pockets, maybe not little, but there are pockets within oil and gas, more gas than oil, that are going to benefit from the AI infrastructure demand pull. So there's clearly differentiation amongst gas companies that are well positioned versus, let's call it, a tier two, oil producer. Same applies to midstream. We think, or rather, we are seeing and capitalizing on a number of opportunities in credit that are beneficiaries of consolidation. So we were, during the April timeframe when the markets went risk off, we put quite a bit of capital into some of these bonds that traded off 10, 20, 30 points. And just this week, one of our positions was acquired, or is announced that it will be acquired rather. And so that's been, an example of another idiosyncratic. So I think for people that are less focused on oil prices and are more focused on what is the algorithm that makes the industry tick? What is it that makes these companies work? Will they exist in their current state? How will they transform over time? So if you're able to really look at these companies fundamentally from a bottoms up perspective, I think you have a decent setup to generate returns, but it's not the oil market of your 2010s where most things went up and to the right.
We've obviously had Adam Rosenzweig on a few times over the years, and I noticed their recent paper was talking about shale potential, and there is a debate out there, right? Is shale sort of rolling over? And we've had sort of multiple points of views on that. And I asked this from a framing of, I know OnyxPoint, you guys are all not unwilling to be contrarian as well. How do you stack up shale versus perhaps the traditional offshore world? And is that offshore world got potentially more upside if you believe that hydrocarbons are out there for the long term? Shale is sort of OPEX heavy, the price of money continues to be high, and you've got somewhat uncertain returns if these fields are rolling over. Is there a narrative for offshore?
I'm not sure that you could conclude from where we sit today that I think implied in your question is this concept that because shale is rolling over, somehow it's okay to be bullish on oil. And I think fundamentally, if you are going to step into projects that have exploration risk, projects that, offshore can be very, I mean, again, we can talk about whether it's deep water or shallow water. Guyana is different offshore than, let's say, Gulf of America. So there is some nuance there, but generally people prefer to work and produce and drill for oil where there is infrastructure in place, where the environment is not very harsh. So we only really go to the offshore markets as investors when there's a really compelling reason to do so. I will tell you that we cut our oil exposure in the fund from a peak of 80%, back when oil was negative and it was like shooting fish in a barrel. Today, we have less than 15% of the fund in oil related to companies. So we're voting with our wallets that we're not in a period of attractive, or as we call it, convex returns in oil. There'll be volatility, it'll be range bound. And the reason for that, Paul, and this is an indirect answer to your question, is you have supply coming on. Hegemony is shifting from the US shales to non-OPEC supply sources, like Guyana is one example. There's a bunch of offshore discoveries, Namibia, et cetera, that are coming on. Vaca Muerta in Argentina is it's just phenomenally prolific.
Yeah.
And on top of that, if you look at the Saudi playbook, they are very much trying to get oil out of the ground today to maximize NPV. And so that's, they just essentially, one of Aramco's affiliates just acquired an offshore drilling rig company, which obviously signals that they are trying to insource some of their infrastructure value chain, which you wouldn't do if you're not going to be drilling for more oil. So yes, shale is in its twilight stages. We wrote about that 2 years ago in an essay. But no, I don't know that I would be rushing to go out and invest in commodity sensitive oil projects, because I think that there is supply elsewhere that's emerging.
Hello, I'm David Hunt, founder and managing director at Hyperion Search. Founded over a decade ago, Hyperion Search has helped organizations from major utilities to startups recruit their leadership teams and key individual contributors to accelerate both their growth and the energy transition. Our three main verticals are renewable power, energy storage, and e-mobility. The energy transition and the talent that delivers it has been our passion since day one. To find out more, visit hyperionsearch.com or listen to my Leaders in Cleantech podcast, available on all platforms.
Okay, well, we're only a quarter of the way through our show notes, so I think we're not going to get with 40 minutes gone. Let's okay. I really enjoyed that. It's great to get your thesis on those, and many of the the points you make we've covered in various ways over the last couple of years. The other challenge, and you highlighted this at the very top, and is prevalent across all of these different markets, is we are fundamentally in a new world where political volatility, geopolitics, but local policy is now much more consequential to the short-term prices than it has been for quite some time, right? And it's certainly an environment that most traders who are now in leadership roles, in their late 30s, 40s, have grew up in a world where actually, relatively speaking, across the developed nations, the range between different parties was relatively small, and the codes of action and behaviors were limited as well, and at least predictable. Where are we? Is it over-egging the statement? We've got a panel coming up in August about sort of beyond fundamentals. Is it over-egging at the moment that really today policy, political decisions, political volatility, the Trump presidency in particular, is really defining market outcomes in the short term?
A couple of different threats to pull on there. So short answer is maybe just to sort of give a little bit of a, to state the obvious here. If you look since the 1980s, or really since the advent of modern monetary policy, which is the Bretton Woods system, the S&P 500, the performance of the S&P 500 is to a very large extent driven by the supply of money. In fact, if you look at a regression since 1980, the R squared, which is a measure of correlation, or a proxy for correlation rather, of stock market performance versus M1, which is supply of money, is about 85 to 95%, and really closer to 95% more consistently. So in a sense, there's nothing different there. And maybe three other points to add to that. Number one, since Bretton Woods, the Fed has been accommodative in 36 out of 52 years, but we've only been in a recession in 7 out of 52 years, which basically means that the Fed is leaning towards an accommodative posture. And inflation, interestingly, has exceeded the Fed's targets 76% of the time. And the Fed's propensity to overstimulate has very little to do with monetary policy and everything to do with the incentive structure at the top. So that's maybe just sort of a starting point. As to the question of policy, I think you're not referring to the Fed, you're talking about fiscal and the geopolitics of what happens in Washington. Look, I think we're in a period of fiscal dominance. What I mean by that is high deficits, high debt, monetary policy. High deficits and high debt means that monetary policy is going to be more dictated by what's happening in the fiscal and the political realm, and less so the way you would normally have expected it to be determined, as we have in the last 20 years, which is sort of more on the basis of unemployment alone and on the basis of the markets. So, yes, I do think for a variety of reasons, we are in a period where policy dominates pretty much every aspect of market behavior. And we found ourselves unwillingly having to study presidential policy, given the start of this year, the market was parsing every tweet from the president to determine when to take him literally, when to take him figuratively, and obviously that has some significant implications for capital deployment and how to position in the market. So that's something that we found ourselves having to study, and we walked away with a number of conclusions. But yes, the short answer to your questions for I do think Washington in large measure today dictates a significant piece of what happens in financial markets.
Yeah. What's interesting there in the new lens, right, is we are the sort of the risks inherent in the economies, and this is across the G7, right? We're seeing it play out in the UK and in France, where very high levels of debt, very high levels of absolute debt service per month, was 160 billion a month in the US at the moment, and the impact that has on Fed decision making and the engagement of politicians with the independent central banks is all heightened as a result of that. I mean, that to me seems like it's if you think, there's a lot of risk in the system. You mentioned the S&P, it's 30 PE. Those are historical highs. I mean, I guess I'm inarticulately and inexpertly asking the question that it seems like a very risky time, and there's a lot of structural issues that perhaps are looming.
I think that probably the biggest there's probably two mega structural issues, one positive, one negative. I think that the main structural issue from the negative side is when you have long-term imbalances that form between an economy's capacity to produce on the one hand and the consumption on the other, you get this negative feedback loop where consumption follows wage growth and it becomes rather price inelastic. So prices go up because the employment market, the labor market rather, is somewhat constrained. Wages go up, which then means consumption goes up further, fueling greater price increases, and the whole thing sort of goes into this negative feedback loop. We've had three bouts of structural inflation in the last 100 years. And they all kind of share similar causal factors, which it starts with a lot of fiscal spending. In our case, that was set off during the pandemic for good reason, but maybe it remained excessive coming out of it. Then you have geopolitical issues, which then leads to more government spending, which then leads to this sort of vicious cycle. And the other negative, maybe to add to that, just to sort of look at what history precedent offers, is the Fed governor in the pre-Nixon era was a guy by the name of Bill McChesney Martin. And he, I suppose, in some ways can be compared to Chairman Powell in the sense that he was very reticent to loosen monetary financial conditions despite getting a bruising reception in Congress where people where the political system was pushing him to create more employment and stimulate more growth. And then in 1970, when President Nixon came in, he appointed Arthur Burns and famously said, I think it was in the Rose Garden, that he said, I respect the Fed's independence. However, I hope that independently the Fed will conclude that my views are the ones that should be followed. And so we all know what happened there. The Burns era in history, which was marked by flip-flopping on rates and not really managing inflation, which ultimately culminated in the Great Inflation. So look, I think those are the negatives. Offsetting that is the positives that can come with productivity gains with AI. So clearly, if AI is capable of unlocking more productivity and by extension, productive capacity, this structural thing that I mentioned about capacity produced versus consumption gets relief. And then on top of that, we're spending, several trillion on building out all this AI infrastructure just in the US alone. So that'll stimulate demand. And so, really, the question is the interplay between those two factors. And I think one of the safe things to build into any kind of outlook today is that the president will appoint somebody who is quite constructive on lowering rates. So, short term rates are going nowhere but down as we see it. Long-term rates are a different question because obviously that's not something you can manipulate. It'll be determined by the fundamentals of the economy, inflation, the deficit, et cetera. So you're looking at a steepening of the yield curve, potentially good for equities on the short term, but bad for inflation. And so AI really sits in the middle of this in terms of where we go. So the market is kind of, one foot on the brakes, one foot on the gas between fear and FOMO. And so it's a very difficult market to make point estimate investments. And by that, I mean, I will invest in X because I think Y will happen. I think that market like this, instead, we look at underwriting to cone of outcomes where we're looking for asymmetry of return and risk. And the idea is that over time, if you can position yourself with a portfolio that makes money more than it loses money in a cone of outcomes, and you can invest in a bunch of uncorrelated things, then obviously that is one of the better ways to position when there's so much uncertainty.
Yeah. Two questions off the back of that. One is, where does and again, it's hard to pass reality in some senses as we now all increasingly live in our own tiny bubbles of one in terms of information that we're given. But obviously there's, if there's that sort of 1970s scenario opens up, or, we're back, there's the risk of stagflation, economic contraction, but inflation. And then where do you see, is that if AI doesn't fill that gap, which there's a lot to, that's, you're requiring, that's not just an economic, that's also a social impact. Could we end up in that world, and what does that mean specifically in the context of how you invest in commodities? Are commodities therefore a reasonable hedge against that scenario?
I think the 1970s would unambiguously tell you the answer is yes, because the initial conditions coming into the 70s is you had sticky inflation coming in, which was starting to abate into the appointment of Arthur Burns. You had reasonably similar labor markets. We're at 4% unemployment today. Back then, it was like 3.5%. We did have major geopolitical shocks. The 1973 oil embargo. You had the 79 Iranian Revolution on the back of the Vietnam War in the 60s. And obviously, there are a number of conflicts in the world today where the US is indirectly involved, and there's spending that goes with that. And then on top of that, you had the Nifty 50. This is the 50 stocks of the time, where basically they were called one decision stocks. And they were one decision stocks because the only decision you had to make was to buy. And so in the 1960s, coming into it, the Nifty 50 generated a 28% annual return, which is, just hard to fathom, but 28% each year with a Sharpe ratio of just under 2. In other words, the risk to reward ratio was quite phenomenal, in addition to just the performance of the Nifty 50. At the time, you had just under 7% nominal GDP growth and 2.4% inflation. Fast forward to the 1970s, where you got inflation to triple, and it averaged, just around 9 to 10%. And you essentially saw the Nifty 50 deliver a negative return annually of 2%. Compare that to the commodity sector, metals and mining, annualized at 15%, energy 20%, agriculture 24%, so on and so forth. So you kind of get the picture. Now, if we look at today, it's all about where do we go over the next 3 to 4 years. If we go into an environment where inflation overtakes all these long duration stocks, where basically cash flow is a promise down the road, are going to be susceptible. And the environment that we're coming into today is not too dissimilar. We've had 5% GDP growth in the lead up, and we've had Goldilocks inflation. So we've had, minimal inflation, nice growth. And the Max 7 has been annualizing at a 49% annualized clip. So the question is, how much longer can that go? And how will inflation and the shift in potential shift, I should say, in monetary policy and the interplay with inflation affect the markets?
It'd be an interesting interview question if you could mask the names of the companies, set your prospective employees back in 1971, give them the same conditions and the same companies, and see which ones they pick, and if they pick the Nifty 50, right?
Well,
Assuming
you've
that
just
that's,
given me a replacement for my $1 million versus the penny question right there.
yeah, assuming it's very old history to these people and they don't know their 70s history, which they probably don't. Yeah, there you go. Final, there's just taking that in, and I'm really enjoying the conversation. Let's take that inflation theme. We're sat here today in, it might be a surprise to our global listeners, but we can't get mail from Europe, right? Birthday cards aren't coming from the UK this year as a result of obviously tariffs and the volatile policies around those, that the mail not moving as a consequence of removing the sub $800 sort of tariff-free exemption. It's easy to discount that. And to date, Wall Street largely has since April. What are you hearing in your circles about, whether, increasing alarm about whether the damage is being done here is not reversible in the short term, and secondarily, how serious actually the administration is on this, and your take on it?
You packed a lot of questions into.
I did, and I get it's easy. It's easy to say I just don't really feel comfortable talking about that, but it'd be good to get your take.
Okay, so maybe to disaggregate that, I think there was a perception at the start of the year that US exceptionalism was here to stay. And then came sort of the tariff tantrums, and the public opinion flipped quite significantly in the other direction for 30, 45 days or whatever the eye of the storm was. It feels like we're back to some version of American exceptionalism again, meaning that America is really the magnet, the United States is the magnet for capital, talent, and growth. And one way to see that, and I think it was the economist from Apollo, Torsten Slok, if I'm saying his name correctly, who put out a couple of interesting charts I saw on that maybe a week or so ago. If you look at the yield on US treasuries, it's actually tighter during non-US market hours than during market hours. So I think the implication of that is there's greater buying activity outside the US than there is inside the US. And then the other thing is if you look at asset class performance on a relative basis, we are once again, the United States market is performing better than its European and Asian counterparts. Again, on a relative basis, adjusted for sort of like for like. So it's certainly, I think, rhetoric, narrative, and politics aside, I think the money flows are telling you that we are still a destination for capital. We've been 70 cents of every dollar allocated to, we being the United States, 7 cents of every dollar allocated for the last 10 plus years. I think the reason that's been the case is because of the breadth of our capital markets, the ingenuity of all the industries. You know, we offered shale, we now offer AI, we offer tech. There's just not a lot of markets that offer the depth and breadth to be able to invest. So I think for that reason, I think the US will continue to be one of the best markets to invest in. Now, the last piece of it is, you know, with all the noise around geopolitics and tariffs, look, I think that's just you know, the US policy uncertainty index under the second Trump presidency is essentially 8 times higher than the first Trump presidency, meaning that the cadence of news flow that is surprising or unexpected is much higher. And I think the market appears to be discounting that because if you look at VIX, which is a measure for volatility, it spiked during the first, you know, 90 days of the presidency. And now we're in a situation where the policy uncertainty index remains elevated, but VIX has come down. That's not a reason for complacency. That's not a reason to say, look, everything is great. We can be business as usual. I think it speaks to the fact that markets are good at discounting events once they start to see precedents. And I think there is now enough of a framework for markets to do that. And then the last piece of this is we're moving into the midterms. And so if you think about the importance of that, the Republican Party has a 2-seat majority in the House, 3 in the Senate. Typical midterms, the incumbent loses 32 seats in the House, 6 in the Senate. And an opposition Congress would obviously be quite detrimental to this presidency in terms of containing its influence, limiting policymaking, increasing the risk of investigations, impeachments, et cetera. So I think it stands to reason that the White House and the GOP will be increasingly pivoting to deal making and good news events as we move into the midterm elections than what has maybe been the case in the first year of the presidency, or so far the first, 8 months of the presidency. So I think for that reason, I don't know about you getting your birthday card on time, but I think you might have less to worry about getting capital flows into the United States.
Yeah, yeah. I mean, the US also I'm not going to get my birthday card, but the US, I'm more worried about my Nottingham Forest jersey showing up. But the US does benefit from the fact that there aren't really viable alternatives, right? You know, it might be having its challenges, but you can look at every other potential investment, and they've got more so. You know, so that's one sort of I think reason why that money will still flow. Well, Shaia, it's been really interesting. I guess before we let you go, can you just give us a bit more on people who might be interested in OnyxPoint Global Markets and what you can do for them? Just a few words on where they can find you and what type of investors you take.
Sure. We typically manage capital on behalf of institutional investors, think pensions, endowments, foundations, insurance companies, et cetera. Best place to reach us is on our website, opglp.com. and we have a contact us button. And we have written extensively about some of the things that I've spoken about over essays, and we'd obviously be quite happy to provide those to anybody who reaches out to us.
Yeah, and I can put links in the show notes to that as well. Well, it's been really fantastic having you on. I look forward to having you back on in a year or so, and we can see where we are, and lots of food for thought there for what's going on in these markets from your lens.
Thanks. It was great to be with you, and I enjoyed our chat this morning.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.